Hello, everybody! Welcome to another episode of Accounting Makes Sense, an MJ the Tutor podcast. This podcast is focused on helping accounting students all over the world by offering a quick warm-up on various accounting and business topics that hopefully leads to the generation of bigger discussions and conversation. For all those studying or thinking about doing CIMA right now, this is for you. In today's episode, we are going to unravel the complexities of IAS 37, the International Financial Reporting Standard governing provisions, contingent liabilities, and contingent assets. In our everyday lives, we often encounter situations that mirror the principles of IAS 37, whether we're budgeting for household expenses or preparing for unexpected emergencies. We'll explore how provisions are budgeted for and managed, and how contingent liabilities require us to be prepared. So, what we'll be doing is to address what we might all be wondering about, which is, what's IAS 37 and how does it relate to my everyday life? Jokes aside, what I wanted to do today is to see how we can make this financial standard come to life through a relatable example, something like home ownership. And then we'll explore how it applies in a business setting. So let's start with the basics. Provisions. Think of these as the regular expected expenses in your life, much like managing a household budget. When you own a home, there are bills you know you'll have to pay, like your mortgage or rent, utility bills, groceries, and insurance premiums. Imagine you're the homeowner and your household budget is your financial statement. Just like businesses, you allocate a portion of your income to cover these known costs, ensuring that you have enough money set aside when they come due. So as an aside, here's a practical tip if you're a homeowner. It's always good practice to create a monthly budget spreadsheet. List all your expected expenses, allocate funds accordingly, and track your spending to ensure you're on target. Now, let's talk about contingent liabilities, the surprises that life throws our way. As a homeowner, you know there's always a chance of the unexpected. Your roof could start leaking during a heavy rainstorm, or your car could break down and you need to have it fixed. Just like in accounting, you acknowledge the possibility of these surprises and set aside some emergency funds to deal with these when they occur. It's like having a financial safety net. Again, as an aside, another practical tip if you're a homeowner, build an emergency fund. Aim to save at least 3 to 6 months worth of living expenses. These funds should act as your contingent liability reserve, providing you with peace of mind and financial security when the unexpected happens. So, now we're going to try and match it up and relate this back to IAS 37. IAS 37 is like the accounting rulebook that businesses follow to manage their financial obligations and uncertainties. It's the professional framework that ensures companies are well prepared like a diligent homeowner. So IAS 37 is the financial compass guiding businesses in setting aside funds for known expenses, such as your provisions. And then they also acknowledge the possibility of unexpected financial hurdles, so like your contingent liabilities. Just as homeowners budget and build an emergency fund, businesses use IAS 37 to plan and safeguard their financial health. In a business context, provisions are like the expected cost that the company anticipates, such as they're paying off employee salary, repaying back any kind of debt, or covering ongoing operational expenses. These are recorded as liabilities in the company's balance sheet and are crucial for accurate financial reporting. You have to report it. If you haven't paid it by reporting date, then you have to record these as accrued. On the other side of things, we also have contingent liabilities in business. Now, these are like your unexpected events. As mentioned, these can impact your company's financial health. So, for instance, if your business is in manufacturing and you manufacture a product There's always that contingent liability associated with products if we have to recall them or there's some issues with them and we get into a legal dispute. While you can't predict when these events would happen, because you never know what could happen with your products, you're not really sure if it's going to break down or anything, or it's going to be faulty or anything, you must always be prepared. If you ever come into a scenario where your customer sues your company for a product-related injury and you didn't anticipate it, it's now going to be potentially a financial obligation. So under IAS 37, you would need to disclose this contingent liability in the financial statements, even if the outcome is uncertain. This provides transparency to your investors and creditors. Now, I want to just be serious for a moment, discuss the technicality of this accounting standard, the rules and conditions that surround this, because I haven't really touched on that, and I kind of just spoke about it in a more relatable example. The technicality of things is that IAS 37 provides this comprehensive framework for recognizing, measuring, and disclosing provisions, contingent liabilities, and contingent assets in the financial statements. This standard ensures uniformity and consistency in how companies account for and disclose obligations, uncertainties, and potential assets. One of the primary areas addressed by IAS 37 is provisions. So provisions in the context of this standard are liabilities with uncertain timing or amount. So you're not really quite sure exactly 100% when it's going to happen. You know it's going to happen, but you're not really sure when exactly. Or maybe perhaps you don't have the exact numbers, but you can reliably estimate it. Provisions, as mentioned, are recognized when there is a present obligation, either legal or constructive as a result of a past event. There's an outflow expected of resources, embodying economic benefits, and it's probable that it's going to happen. And then the third one is that your amount for this obligation can be reliably estimated. Doesn't say 100% exact numbers, but you can reliably estimate it. Provisions are recorded in the financial statements as liabilities, and the amounts reflect the best estimate of the expenditure required to settle the obligation. Provisions are reviewed at each reporting date, and adjustments are made to reflect the best estimate at that time. Now, where does contingent liability come in? IAS 37 also addresses contingent liability, and these are potential obligations that may arise from past events. So they're actually very similar to provisions, except that for contingent liability, one of the things that is a big difference between provisions and contingent liability is that contingent liability is not an entry that you record in the books. It's a note that you disclose in the financial statements where you actually speak about the possibility that an outflow could happen depending on the outcome. Contingent liability are assessed based on whether it is probable or remote that an outflow or resources will be required to settle the obligation. So they may relate to legal disputes, warranty claims, or other uncertainties. On the flip side, there is also contingent assets, which could arise from past events. They're also not recognized in the financial statements, but are disclosed if the realization is probable. So these are potential future economic benefits that may flow into the company. IAS 37 places significant emphasis on disclosure requirements. So companies are required to provide extensive information in the financial statements about the nature and amount of provisions, the timing of expected outflows, and the uncertainties surrounding the obligations. Disclosure of contingent liabilities and, in certain cases, contingent assets are also mandatory to provide a comprehensive view of a company's financial position and potential risks. So IAS 37, although, technically it's a little bit intricate, it does play a pivotal role in financial reporting, both in the everyday life of people and the business world. Its principles of provisions, contingent liabilities, and contingent assets ensure the financial statements present a true and fair view of the company's financial position. And there you have it. That's a glimpse into the world of IAS 37. Provisions and contingent liabilities, both in our everyday lives and in the business world. Remember, whether you're budgeting for your home or you're assessing a company's financial health, the principles of IAS 37 are all around us. Anyway, thank you for listening to Accounting Makes Sense. As always, I am your host, MJ the Tutor. If you're keen to connect to be updated with the arrival of the next episode of this podcast or find CIMA resources online, please head on over to my website, www.mjthetutor.com. You can also hit subscribe on whichever platform you are using to listen to this podcast. If you want to connect on social media, I'm on Facebook, Twitter, and Instagram under the name MJ the Tutor. So, I hope to see you again next time. Ciao for now!